Welcome back to Switzer. With the Aussie dollar falling and the possibility of a recession, it's time to get some strong stock picks from Roger Montgomery, the CIO of Montgomery Investment Management. How you going? How you going?
I'm going very, very well.
Okay.
We're delighted with how things are panning out.
Yeah. Okay. Well, you're waiting. You're holding cash. You're waiting for a bit of opportunity. But
about 2 weeks ago, we went to about 40% cash.
Yeah.
So actually, we're 45 or 46% cash now in the private fund.
Yeah. Still not diving in. You're waiting a bit more.
We're waiting a little bit longer. Yeah, we took a lot of profit off the table, obviously. We're delighted with how things are panning out because it seems to be playing to the hymn book that we've been reading.
Yep, same here, mate. But I don't crow as loud as you do. But that's your business. That's your business. But one thing I'm worried about not crowing about, talking about is recession.
Sure.
What's your thinking behind the recession?
Well, what we did 2 weeks ago, we received some information from a company called Worley Parsons. Yeah. And lots of brokers received this. It was on a conference call, and they said, I can't remember the exact words, but it was I'm paraphrasing, along the lines of, these conditions that we're seeing in WA are worse than the depths of the GFC. So we thought about that. We got on the phone, we started talking to people in Perth, and we found out, anecdotally only of course, but we discovered that people in the street were saying that things are pretty depressed, that are pretty quiet, that it's nothing like it used to be, and it feels like confidence is gone. Yeah. So we took that on board and we thought, well, what actually happens if we know the mining services thing is off the boil? Yeah. The Bureau of Resource and Energy Economics came out and said that they expect mining capital expenditure to decline 75% between now and 2017. So it's only 4 years away. And that mining capital expenditure contributes about 1.5% to economic growth. Economic growth at the moment is about 3.1% seasonally adjusted. So if you think that 1.5% is just going to be sliced off, possibly, then what else is going to fill the gap? First one is residential construction. Now, that's picking up at the moment. Why is that picking up? You're doing your economics 101.
CIG plus X minus.
Yeah, exactly. So we've got, for those people who don't know that formula, you've got residential construction. Now that could pick up. Yeah. But
that's the I part.
And we've seen better sales in auctions and clearance rates and that sort of thing. But that's a function of the confidence that was boosted from October onwards. Yeah. It's sort of the end. People are waiting on, is it still good? Is it still good? Yeah, I'll buy. And they've organised their borrowing earlier. But if the dust storm from WA blows over the Nullarbor and comes over to the eastern seaboard, that would stop. And it's not enough to fill the gap from mining construction and CapEx anyway.
Okay. Remember, you got to give us how many stocks before you go?
Yeah, 2 or 3.
Okay, I'm watching.
Well, you tell me. You wind me up when it's getting close.
Well, I guess, in a nutshell.
Okay,
it's a big bag of nuts. I want a nutshell.
So residential's not going to happen. Yeah. Net exports is already contributing negatively, but that's because of the strong Australian dollar. That could pick up if the Aussie dollar drops, and I think it will drop. I'm short lots and lots of Australian dollars. That will drop, but it's got to stay down in order for people to feel encouraged to start investing in net exports. And then you've got government spending; they can't afford to spend.
But they are going for a deficit. They are going for a deficit.
Yeah, well, that's all right. Good.
And of course, the big hope is that interest rate will get consumers going. So, and I think after the election there will be a kick up, and that's going to be interesting.
All right. Well, I hope you're right because interest rates have been very low for quite some time now. Now they keep coming.
I was harassing the bank last year, and people were writing and saying, "Leave that poor bank alone. Give us the Christmas. Give us the Christmas."
Okay, so the companies that will do well, we believe.
Okay, this is the part we got the pen out for.
Are the companies that earn their profits away from Australia?
Okay.
Right. Yeah, so CSL, for example, QBE, perhaps Cochlear, although there's the analysts have come out. No, the analysts have come out again, time and time again. You can look at the history of Cochlear, and every time Advanced Bionics or one of their competitors comes out with a better product, everyone goes, "Oh no, they're going to lose market share." Share price plunges, you buy it, and away you go.
Okay, yep.
So that happens. So Cochlear, CSL, and QBE are the 3 companies. Oh, and you could probably throw ResMed in there as well.
So these are all companies you like. they obviously don't carry worrying amounts of debt because you wouldn't even be talking about
Correct.
it. Their cash position must be pretty good too.
Yeah, absolutely. Return on equity is very high.
The low dollar here.
They're not necessarily cheap right now.
No.
But what's happening is a lot of people are looking at the intrinsic value based on consensus analyst estimates. And I think what will happen is as the Aussie dollar drops, you'll see analysts upgrading their estimates. And then the intrinsic values, if you base them on consensus analyst estimates, will start to rise. Now, in the meantime, Australia could have a recession for the reasons we've described.
It's always possible.
And if that happens, people throw the baby out with the bathwater. So I don't know how it's going to play out.
More opportunities for that
now,
little...
what we did is we sold all of our, a lot of our retail stocks a couple of weeks ago. So the JB Hi-Fis of the world, we sold down the Reject Shop. We sold a few other retail exposed stocks.
Totally gone. Off the books.
JB Hi-Fi is not in the portfolio now in the Montgomery private fund.
Reject Shop.
Reject Shop, we own half.
Hard for you to reject Reject Shop.
We sold half, but we've kept half. And the reason we did that is they were above the intrinsic value. We didn't think they would run much further, though we didn't know. They were well above intrinsic value to us, and we believed that this dust storm from WA, I'll call it, could affect the eastern seaboard, and then people will start to pull their heads in again. Consumption will decline. It'll flatten out. We might get a recession, and people won't want retail stocks.
But Reject Shop does well in downturns.
Yes, I know, but people first they pull the trigger first, they shoot first and ask questions later.
Yes.
So and it was the market was stretched, valuations were high, prices were high relative to valuations. We couldn't find anything new to buy. Remember I was on the show saying can't find a lot to buy at the moment.
You tossed some foreign companies there, so I think.
And
David did that.
And so we said, well, on balance the risk is to the downside. Our first objective with our clients' money is to preserve capital, so we went back to about 40% cash.
Okay. QBE. Now, this is an insurance company. As a company I've liked, I've supported even though it went down, and sure, it's starting to improve now. But it's difficult for you to be confident about their economic performance because you've got natural disasters and stuff like that.
Well, that's the thing.
Is that a problem for you?
Of course it is.
Because you like consistent or predictable economic performance.
And investing,
so I do listen to you, Roger.
Thank you, Pete. And investing in insurance companies today is not the same as it was 10 or 15 years ago, because it seems we have a lot more disasters. However, our belief is that those disasters may normalise.
Yes.
Okay, we won't get so many of them in quick succession. If that's right, then the way QBE will benefit is firstly from an increase in interest rates in the United States.
That's going to happen.
They've got a very short duration bond portfolio. Now what that means is that because it's short duration, when interest rates go up, the bonds mature relatively quickly and they get to invest at the higher interest rate.
Exactly right.
So they're going to benefit while their competitors probably won't, because their competitors have much longer. So what's the scenario that all the macroeconomics economists are talking about? They're talking about the American economy strengthening, the Australian economy slowing down, US dollar going up, Aussie dollar going down, US interest rates going up. So not only does QBE or investors in QBE benefit from their portfolio returns going up, but they also benefit when those profits are transferred back into weaker Australian dollars. So you get the double whammy, if you like, a double header benefit. And that's what we like about it. We think the other issue is, or the other benefit is, that the present value of their liabilities, the present value of the liabilities goes down when interest rates go up, and that adds to their profits as well. And a lot of analysts, well, most analysts who cover insurance know about this, but a lot of analysts and commentators who don't cover insurance don't know about that, and that could be another kicker.
Okay, interesting. One thing I'd love you to have a look at, we did an interview of Michael Knox on Monday night. I presume you missed it. I don't know how you did that. But he,
I was at the office working.
He actually made the point that steel production in China is extraordinarily high at the moment. So he's tipping that commodity prices are going to spike later in the year.
Whatever. I love the optimism, but the issue, they're trying to just keep people employed, right? They're just trying to keep people employed. So they're going through their stock.
The Chinese, not Michael Knox.
No, the Chinese are just...
The RBS people being employed by Michael's optimism.
I hope he's right. But you never ask a barber whether you need a haircut, right? So
why not? I trust a good barber. Do I need a haircut?
They're always going to say yes.
You need one as a matter of fact.
I need one, I know, and I'm going to get one tomorrow. I'm sorry I didn't get one today. But the point being that the Chinese steel mills, the government doesn't care whether they lose money or not. They want to keep people employed because it has benefits in the broader economy.
Fair.
And they're just running down their stockpile. It doesn't mean they're going to replace and replenish the stockpile at the same rate as they have in the past.
This economic and market game, it's always a guessing game, but it's always exciting.
I think you just want to have good guesses.
That's right. All right, mate, thanks for joining us on the program. If you want to read my thoughts each morning at the close of Wall Street, check out my website, switzer.com.au. And if you're a self-managed super fund, have a look at the Switzer superreport.com.au website, where great writers like Roger Montgomery turn up and give great tips. And if you've got any questions for me or ones you'd like me to put out to an expert, email me switzer@skynews.com.au. I'm Peter Switzer. Thanks for watching.